our series of ratios to know. Previously, we've had a look at the current ratio and the quick ratio. Both of them took a look at our short-term ability to pay our expenses. Today, we're going to examine the debt to assets ratio. It's very simple to calculate, so it's not all that exciting, but it is something that's really important for a small business owner to know and understand. Just a quick word on the ratios we look at. They generally fall into three categories: liquidity, solvency, and profitability. And the debt to assets ratio is a measure of solvency, which refers to meeting our long-term expenses. Our debt to total assets ratio is an indicator of the percentage of a business's assets which are being funded through debt. The calculation, as I mentioned, really is quite simple. We're just going to take total liabilities, divide them by the total assets, and then multiply by 100 to gain a percentage. So we're going back to our financial statements from the accountant. Trawl through them again. You're looking for your statement of financial position, which might actually be called a balance sheet on there. For the purposes of example, I've actually pulled up three very different balance sheets from three different local businesses to have a look at what their debt to asset ratio is and what that means for them. Our first example comes from a sole trader in the retail industry. We're looking down his balance sheet, and this time we're going to go for the total liabilities, and we're going to divide that by the total of the assets. Now remember, last time we just looked at current assets and current liabilities. So we're after the totals this time. We're going to multiply by figure by 100 to get a percentage, and we're at 24.16% is his debt to asset ratio. Now this tells us that he's not very reliant on debt at all, and actually less than a quarter of his business assets are financed that way. One of the benefits of a low debt ratio for him is there's going to be a lot less pressure on cash flow. He's not funneling out a lot of revenue to service debt, and presumably there's a capacity to borrow there should he wish to expand the business. You might recognise the balance sheet in our second example. We've used this one before in our previous screencasts. This is our retailer who's been trading in that line for a little over 12 months now. Total liabilities divided by total assets is going to give us a debt to assets ratio of 81.84%. Now this tells us that 82% of the assets on the balance sheet there are actually financed through debt. But if we just jump back to his balance sheet here for a moment, we can see that what he's done is he's used debt to provide a source of capital to start his current business. One of the benefits of this for him is he's going to be able to deduct his interest payments on his borrowings on his tax, so there's a tax benefit there for him. And our final example is a company in the service industry whom we'll see is very highly leveraged. Total liabilities divided by total assets, 123.3%. Now this tells us that this business actually has more debt than it does assets, and they're at a bit of risk here. This is going to put extreme pressure on cash flow. If there were changes to the revenue coming in or something like that, it's highly likely that there wouldn't be enough funds to actually service repayments. So that's a real risk. There really is no ideal debt to asset ratio. Some things that you might want to give consideration to though are what's the norm in your particular industry? How comfortable are you personally with having a high debt? Are you still going to be able to sleep at night? And don't forget to consider the tax advantages of financing. And that's it from us in this cast on Ratios to Know. Join us next time. We'll look at some more maths tricks